All right. Let's see. Got all the socials, or at least the ones that matter. All right. Let's get started. Hello, Smart Money Tube podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. So today I'm joined with Doug Hagren. Hey, Doug.
Good morning, Kirk. Hey, we were just having a nice conversation. What?
It's afternoon.
Oh, good afternoon. Well, yeah, it is everywhere, everywhere except unless you're listening in Denver and
everywhere that matters.
Yeah, that's right. So the way I'm on the Mississippi Divide right here in the Twin Cities, but other than that, west of the Mississippi, nobody's paying attention to right now. So
that's all right. I'm from Boston, so if it's as long as it's not my backyard, I don't really care what happens.
No,
we're a different breed over here.
What Kirk cares about is having a drink with an umbrella in it. That's what matters.
Only if I have my pinky raised, Doug.
That's anyway. And not because you want $1 million, right?
And now it's $1 trillion. That movie has not aged well.
But by the way, I believe they are coming out. No, they're not coming out with another Austin Powers. They're coming out with another Shrek.
Oh,
I know.
So I think I sent this to you, Doug. So somebody sent me. The Snow White film was such a disaster from what I've heard from the non-kids, right? I mean, sure, the kids loved it, but for the non-kids who saw the old one, it was such a disaster with everybody that there was some really funny YouTube videos where they came up with a song that shows it basically what they've done is they've taken all the comments, the really funny comments, and turned it into a song. It's hilarious. They have 4 or 5 parts that you can get these different videos on Snow White. It's absolutely hilarious. My favorite's the first one, but the other ones are funny too. And then they started to do one on Shrek, on the next Shrek. I was like, I mean, Shrek was great for the first one and maybe the second one. The third one was kind of reaching. I don't know if there's 4 or 5. But
oh gosh, yeah, no, it went downhill badly.
It's just once you're really milking the franchise that much, you're beating it like a dead horse. All right, we're done. But for whatever reason, maybe it's cheap enough to produce, so they'll just keep cranking out crap like most of the streaming services. I have to say, I know it's Good Friday, so I'm going to try to be good, but I have to go on a little mini rant here that I absolutely, I'll just say I very much dislike movies nowadays. So a lot of people like art. Some people like fine art. Some people like, paintings, photography, sculpture, whatever. My art is cinema, film, and I love movies. And, I'm just a movie buff. And I took actually a course in college. It was, I forget what it was called. It was basically something in film. And it was great. And actually took a course in college. It was on the mafia. It was, basically, it was a wonderful course, but there were a few books. It was about the Italian mafia, not the U.S. mafia. And so you'd read a book, and then you'd watch a movie. So we watched Donnie Brasco, we watched The Godfather, and then we watched Goodfellas. And the contrast was the 3 levels of the mafia. There was the Dons, there was the mid-level guys, and then there was the lower ranks. And it was a really cool course. The guy did a great job with it. Anyway, so I always love film, so I always appreciate the different aspects of it. And I have to say that they are not making good films anymore. No. And it's almost like they've realized that I could make a 10 out of 10 film and it'll cost $100 million, or it'll cost me $10 million and I can make 6 or 7 out of 10, and people still buy it. And they've realized why we spend all this money. And I realized all these movies stink.
Yeah.
And they're all on, you're cranking out crap on streaming. And they're oh, I can just put a name actor and put it in some basically it's the new sitcom. It's garbage, but they keep doing it. And it's it's good enough so it's entertaining, but it's not good enough so I'm enjoying it. It's like drinking whiskey. If you don't like whiskey, it's yeah, it'll get you drunk, but you're not going to enjoy it.
It's the marveling of Hollywood. I mean, they realized, look, let's just throw anything out there, make big money, brand names. Disney went out there. Of course, they ruined them, trying to get Star Wars and Marvel and Pixar and all that. At the end of the day, they're finding I can, unless it's James Cameron, who can never do anything but hit home runs.
Yeah.
They're basically they're like, look, we can spend $100 million, something artsy, creative, but we can't draw people in who want to see it and lose our shirts. Or we can make some garbage. I mean, Netflix is doing this. Netflix is just doing foreign films now. Like, it's cheap. I get people to watch this stuff. It's the incentive. And I think the writer's strike did not help this, by the way. I think we're still feeling a lot of the effects because it's probably a 2 to 3 year lag on writing anything. But we're finding that just going out there and finding good writing, trying to come up with something new and creative, and taking that risk just isn't worth it. Let's just keep pumping out remakes and known brands,
Right.
and then of course Disney them and figure out how to ruin them anyway.
So it's interesting. So Disney has basically, they were the first one to go in and start grabbing all of these IP. And I have to say, Disney is one of the more famous companies at being great at keeping IP like long term, like Mickey Mouse or Steamboat Mickey, I think was the original one. All these cartoons, like brilliantly done back in the day. And then I don't know what happened. Maybe it was the woke movement or whatever, but something happened about, maybe it was right around COVID, maybe it was before that, but they started completely destroying their franchises. So the Marvel movies for the first generation up to like Infinity Wars and what was the End Game? I think it was the second one. So the End Game was the last one in that grouping series. That was well done, in my opinion. I mean, there were maybe a handful in there that were crap, but generally speaking, they were well done. The whole thing, I give them a lot of credit. I'm a fan of comics and superheroes, so I really enjoyed it. Subsequently, they realized, hey, people really like this stuff. Let's just abuse this franchise, and we'll come out with a lot of crap on streaming. They took advantage of Scarlett Johansson and basically screwed her over when she had her Black Widow movie, and things just went downhill. And they've got all their stuff now on streaming, which is enjoyable in the sense that I enjoy the storyline because I geek out on this stuff, but the quality of it was really garbage. And and then they were going to start another phase where the Kang was going to be the evil, villain. And they started down that. And then I guess the character, Jonathan Majors, I think his name was, he got
Too.
What?
Another Me Too situation.
I don't know what he did, but he did something that was, let's say, publicly not liked. I don't know if he beat his wife or something. Like, he did something. I don't want to disparage the guy because I don't know what he did, but he did something that was publicly like, oh wow, we got to distance ourselves from this guy. So they pretty much removed him, and then they were going different directions. Anyway, right now they don't know what they're doing, and people have stopped watching the movies and the series because they're crap. Like, they just came out with one and it's crap. Like, I know it's crap because I've seen a few of the other shows, and somehow that made it on YouTube. Like, I got to see the New World Order on YouTube for free because someone copyrighted it and dumped it up there, and I watched it. And it's crap. I probably definitely wouldn't have spent $20 to see that. But point being is, things have changed since COVID. The Star Wars franchise, they've killed that too. People hated it. I didn't hate it because I was like, all right, this is interesting, but it wasn't the best version of Star Wars. Let's put it that way. And now they've got a lot of sub shows and they're breaking apart. Anyway, a lot of unhappy people. And I'm going to mention one more thing, and I'll kind of frame it back around because I think it's important to understand. If you understand, like, the film industry, like, the way that they used to do it was the right way. So Star Wars, they come out with a movie, and maybe 5-10 years later, like, people would geek out on it. They'd buy all the stuff, the collectibles, the action figures, all the stuff, the memorabilia, and then they'd forget about it. 5 years later, it's like, oh, there's another one coming. I can't wait to see it. And they would dump everything on you with one movie, and then they'd let it fester, and they'd say, all right, I need to get that desire again. I want to see it. I can't wait for the next movie. And they stopped doing that. They started, like, cranking stuff out because they're trying to make more and more money. And that's great for the shareholders, but long term, it's really bad for the brand because now people really don't like Star Wars. I'm hit or miss on it. I didn't hate it, but wasn't like the first 6, that's for sure. The last 3. But anyway, so the point being is, now you have Amazon, which has bought the James Bond franchise, and they've done nothing with it. But from what I've heard, is they're about to destroy that franchise too.
Yeah, the Broccoli family is no longer going to be involved anymore.
Right. Yep. Yeah. The family that had creative oversight over the movies and have delivered, in my opinion, wonderful movies. Whether you like James Bond or not, they've done a great job of keeping throughout decades through culture changes. Right. You remember watching this first Sean Connery ones where there was one movie. I think it was. I don't know. It was one of the supermodels of the time who was like the babe in the movie. She was like, they were like tied up outside in the beach and they're both out there. Anyway, I remember him like slapping her. like, that's so wrong. But at the time it was just like, it was okay. So I'm, by the way, totally disagree with that being okay. But culturally we've evolved is my point. So back then we were a different culture than we are now. And yet James Bond franchise has held through all those different cultural changes, which to me is magic. Whatever they've done is magic. Now, I'm going to predict that Amazon is going to completely destroy that franchise now because they're going to put in their own creative genius and they're going to say, well, we know better because all these smart people think they're smarter than everybody else. And then what they don't realize is that what they were doing actually worked and they should just keep doing it. So one James Bond movie every 3 to 5 years, they're going to probably destroy it. So anyway, my point is I geek out in this stuff, and I think that the certain companies that own these rights to these films, they need to get their collective shit together, or people just aren't going to watch movies anymore. I mean, what are you going to see in a movie theater? I don't know why I would go to a movie theater anymore. There's
Minecraft movie.
What?
The Minecraft movie.
Yeah, my kids saw that. My kids don't like movies, and they saw that. So I think that's like the Austin Powers of their generation.
Yeah, pretty much.
I haven't seen it, but I'm guessing that's what it is. The stupid humor that you're just like, all right, this is funny, but I can't admit it's funny because it's stupid. Like Happy Gilmore, Billy Madison, like movies like that. Old School. Old School is kind of funny though. But yeah. Anyway,
I'm gonna add two little things and we'll move on. Number one, it does look like Austin Powers is rumored it might be in development, so there might be an Austin Powers number 4. We'll see what happens there. And and at the end of the day, they are. I mean, this just tells you everything you need, and nobody's gonna be happy because I was reading comments and people listing their favorite James Bond, and the overwhelming majority was that a lot of people thought Timothy Dalton was one of the best and Pierce Brosnan was one of the best. They just thought Pierce Brosnan was ruined by bad writing. I'm not sure I ever looked at Pierce Brosnan as one of the best when you're comparing it to Sean Connery. It's amazing, but now some of the early ones are at the bottom of the list, which tells you the recency bias of these people, of whoever's watching. And anyway, we'll see what happens with the franchise, but we'll go from there. Moving on.
So. Yeah, I'm a little give and take on Timothy Dalton. I like Sean Connery; he was great, and certainly I like Pierce Brosnan. I think he did a great job. It's a different feel of the movie. I think the movie just felt different. Like I think he did a good job, and he was definitely James Bond. And I like Daniel Craig too. I think he did a wonderful job in the recent series. There were definitely some in there that weren't great, but anyway, let's move on. So it's Good Friday, so the markets are closed. I think a lot of people will be thankful for that. Because last week we had the last few weeks we've had a lot of volatility. We've had some of the highest volatility we've seen since COVID, actually. And the VIX, let me see if I can bring it up. The VIX right now is at 26.5. It got as high as looks like
53.
I thought it went up there. I'm looking at this thing here, and it says it was like under 45, but I'm not believing that. I think it was like in the 50s.
It got up to 53 at one point. I okay. Somewhere around that range. I don't know 100%, but yeah, it was definitely over 50.
Yeah, I'm looking at this, and I'm definitely not seeing. I'm pretty sure it was up there, but anyway, yeah, this is weird. This is the futures. That's why. Okay, so anyway, so getting back to it, so. The thing to take away from this is we had a huge spike in volatility because of the tariffs, and people thought that Trump he blinked and just said, all right, we're going to give everybody a 90-day reprieve. But really, if you think about, I'm going to make this frame that'll upset a lot of people, but I think if you're a if you're trying to be an open-minded, thoughtful person, you need to be able to look at both sides without judgment. Whether you like Trump or not, the vast majority of the people in the country like him because they voted for him, and certainly a little less than half don't like him, which I understand as well. However, you have to look at him and realize that even if you think he's uncouth, he's boorish, he's all these things that you don't like, he's very good at certain things, and you have to give him credit for that, right? He's a very good negotiator. If you like it or not, he is a master negotiator. It's what he does for a living, right? So you also have to understand that here's a guy who had no political experience and became president. No one else has done that. I mean, I don't know, maybe if you go back far enough, but no one's really done that. So he has some skills, like it or not, he has some skills that have got him there. And the one thing you have to take away is we're talking about like the tariffs and how to think about tariffs and how to think about what's going on. As we went from a period of pretty much lethargy and pretty much just people not paying attention to the markets, there's no risk, everything's fine. And Trump put risk back in the markets. Now, you don't like it when that happens because risk means the market goes down, but it is a good thing. We shouldn't have a VIX in the single digits. It's not healthy, right? And I'm not sure when that happened. It happened a while ago, but it's in the low double digits. It's in the 10 to 15 range. That's unhealthy. It shouldn't be there. That means there's no risk at all. Of course there's risk. There's risk everywhere. But it also shouldn't be at 50, right? 50 means that there's something bad going on. Now, most people look at the equity markets because that's what they care about and that's what their portfolios are in equities. But the reality is that's not what people were worried about. People were not worried about equities going down. They were worried about bonds going down. Now, there was a little bit of a small freak out last week in the bond market where bonds started to lose value. People started to dump bonds. And when they're selling them, that means the yield goes up. If the yield goes up, it gets really expensive to finance our debt. So what ended up happening is the 10-year note, 10-year treasury note is the most important yield on the planet. Everything's based on it. And so when that starts to bounce higher, they need to do something to tamp it down so it doesn't take off. Now, there's this back and forth going on between Trump and Jay Powell. It started when, right before Trump was inaugurated, but after he got elected. Trump doesn't like him very much, and Powell doesn't like him very much, and Powell is basically going to do what he's going to do. I don't know where this ends up, but I know it ends up with Powell not getting reaffirmed in next year. But the question is whether something happens before that. Now, if you remember back to COVID, Powell didn't do very much. And Trump verbally beat him up over the media nonstop during COVID. And finally he caved and said, all right, we're gonna basically buy everything that's not nailed down. Now, that is the holy crap moment that caused the markets to bottom out and then start to take off. So I want you all to pay attention. The Fed, whether they're worried or not, they're not showing it. Powell came out this past week and basically said, well, we're going to wait and see what happens. For the most part, he said a lot of stuff. Market didn't like what he said, so the market sold off. But basically what he said was, we're going to see what happens. We're not making any changes. Now, Trump's out there talking on social media about how the EU dropped, or the European Central Bank, the ECB, dropped rates this week again, and they keep dropping rates. And he's like, why are they doing it? We're sitting here on our hands. I'm actually I'm of two minds on this. I think our market is strong enough to withstand the high rates we have. So I'm actually, and I thought Jay Powell, when he dropped rates 100 basis points before the election, I thought that was obvious manipulation of the election. Why would you do it a month before? I thought that's stupid and crazy, and I'm surprised Trump didn't say anything. But to me, it was pretty obvious that was not something you do right before the election. But he did it, so I'd be pretty pissed if I was Trump. But anyway, so he hasn't done anything since. I don't think they should have dropped it then. I don't think they should drop it now. But that's what's going to happen. because what Trump's doing is causing volatility in the markets, which is probably going to cause a sell-off over the next 3 months. We've been predicting this in the show. We've told you, so hopefully you've paid attention. And we think that, you know, the sell-off is going to continue. It's not going to be a straight line. It's not going to be a crash, but I do expect the markets to be lower at some point in time over the next 3 months. And I expect right now the S&P is down around 10%, negative 10%. I expect it to be negative 30, negative 40 at some point this year. That's my expectations. And if that happens, I do expect the Fed to step in and lower rates. And so if you've been around the markets as long as I have, and there are people longer for sure, but I've been doing this for 25 years, and I can tell you I've seen this game played out many times before. This is what happens. Push the markets down. The Fed comes in, saves the day, lowers rates, and then the markets go back up. Who's a hero? The Fed's a hero. Trump's a hero, right? Because the markets end up going up, low rates. Now they can refinance their debt at low rates, so on and so forth. That playbook has happened so many times that everyone listening to this should already know it. It's so commonplace, it's not even a secret anymore. So I think that's probably going to happen again. Until that happens, I think we might see a recession. I'd say I'd be surprised if we don't. And, you know, it's not going to be bad because our economy's fine. We're just, you know, we're hitting a rough patch, and certainly the tariffs are kicking some business owners in the teeth for sure. And I'm not making light of the fact. I don't really have an opinion on the tariffs at the moment because I do see them as a negotiation tool, not as a permanent thing. Trump talks about them like they're permanent, but I don't think they're permanent. I think it's just basically a negotiation tool to get people to the table, which we've seen is what he's done. He put a pause on them, and then they're going to negotiate and then come back. Except for China, which he's kept those on because he's in a war with China right now, and he's not giving up. So I think we can see more stuff there. But just keep in mind that uncertainty is what the market doesn't like. Businesses don't like uncertainty. So I can expect the next 6 months will be a lot of uncertainty, followed by a period of pretty certain confidence in the global economy. So I think the other side of this will be good. But until we get there, it'll be rocky. And you should definitely have a pile of cash sitting around to take advantage of that. And as I do, and I'm just waiting. I didn't see the negative 20 as good enough. I think we're gonna see lower prices, and I'm hopeful we see those sooner than later, so we can jump in and take advantage of that. So, Doug, what are you seeing? What are some?
I'm gonna tie this back to our movie analogy. I don't know who you are. I don't know what your portfolio looks like. But if you're betting on calm markets and business as usual, I can tell you that's not how I play. What I do have is a very particular set of skills forged in real estate boardrooms and battle tested in the trading floor of global politics. I move tariffs like levers. I rattle the indexes. And when I say deal, the Dow moves. You want certainty? That's cute. I offer opportunity, high risk, high reward. That's what we're getting. I mean, yeah, go back to the movie Taken, because that's exactly how he is positioning right now. And he is going, you know, he's going to drop tariffs like plot twists. He's going to shake markets with a single twist. He's going to renegotiate deals on a golf course. And if you work with him, he's going to make a deal. But just get ready for volatility. Here's the thing. And I may have mentioned this previously in some conversations, but I am friends with someone who's a very influential position in the global marketplace. He is with a major bank. He does mergers and acquisitions. So he gets to see this every day. And he is with an institution that is not domestic based. So they are very influenced by what's going on with us, and they get to hear very clearly what's going on with the rest of the world. And the reality of the situation is this is something Americans don't appreciate. Okay. We don't like discomfort. We are used to a very, very cushy position here where we can complain about whatever it is we want. Some people call this first world problems. But what happens, and the rest of the world knows this. So you think of the wars and conflicts we've been in, Afghanistan, Vietnam. When we start, we like the victory. We like America to be strong in the international stage. But when we start to see the realities of that, when we start to see blood, when we start to see unhappiness, we get very uncomfortable. We are a joke when it comes to negotiations around the world. Go to the Caribbean sometime. Go to Mexico. They'll come up to you and they'll try to offer you something. Americans are easy targets because we'll just pay whatever first crazy price that they offer because we don't like to negotiate. We're not used to it. We're used to going into Target and buying whatever the price tag is. You don't go into Target and negotiate. Yeah, that looks good, but let me haggle you a little bit. We don't do that. We're uncomfortable in it. But that's the way the world works. And this gentleman was saying, look, I see this in boardrooms every day. It gets uncomfortable. We see a little blood on the TV screen. We want out. We're done. American public can't take it. And this is playing out in the public space because Trump loves, he's a showman. Remember, Art of the Deal. That book was all marketing for the Trump brand. The Apprentice was all marketing for the Trump brand. He's a showman. He always has been. He's going to tell you everything he wants. He's going to move needles. He doesn't care. But what you're seeing is the ugliness of what goes on in negotiating boardrooms every single day. You're seeing the ugliness that goes on in mergers and acquisitions every single day. And we don't like it. But what he's doing is he's playing very strong rhetoric out there to try to get an outcome that, listen, if it goes well, we're going to win, right? It's going to be a great position for America to deleverage our relationship with China, to give us more opportunities for fairness on our global supply chain. But people are forgetting how reliant we were after 2020. Everything shut down. And even after things started loosening back up, we couldn't get goods because China continued to shut things down. They continued to control whether or not we were going to get anything shipped across the ocean. There were tankers sitting empty. Okay, that was, if you forgot that, you need to go back and look at what that was like. And that can be that's a situation we're stuck in every single day. Anytime China decides they're going to cut us off from getting stuff, we're poised to be a victim of that. Okay. And so, yeah, is it about, people are like, wow, we don't need to have manufacturing back here. Well, maybe to some degree we don't, but do we need to deleverage having one country in a position of controlling, our destiny? And the reality is a huge risk. And so if this is successful, it's going to be incredibly important for our health as a nation to not be reliant this much on one country. If it fails, and right now you are seeing the nastiness that goes on in boardrooms, it's going to be, you're going to feel a lot of hurt for a long time, right? And that's what the markets are scared of right now. They don't like uncertainty because they see that if this doesn't go well, if we can't move our relations to other countries, China holds the cars and sticks their feet in the sand, we're going to feel that pain, and the markets don't like that. Now, if we're able to move those relationships and create better global relations elsewhere, if we can prevent China from just shipping their goods through other people to us secretly, then we're going to be at a great position. But right now, nobody knows how that's going to play out. But somebody's got to make some changes because the status quo isn't working. So Trump's trying to make changes, and those changes are very polarizing. So what I see is that exactly what you said, Kurt. It's going to continue because that negotiation isn't done. There's going to be days where he's going to tweet, things are coming together, yay! And then there's going to be days he's going to tweet that, well, it's not, so we're going to go even harder, and China's going to come back and say they're going to go even harder, and we're going to feel pain. So continue to understand this. Volatility is here to stay indefinitely. Now, indefinitely doesn't mean permanently. A lot of people think that. It just means we don't know where the end is.
Yeah, no, I think that's important is just, I think we have this, as human beings, we have this problem with time, and, we call it here time dilation, and time dilation is effectively looking at something and assuming that it's gonna always be the case, right? You can also call it recency bias. But when people are looking at a situation like, oh my God, tariffs are going to destroy this country, I'm like, yeah, I don't buy that. Yeah, they could, but the reality is nobody wants that to happen, so it's not going to happen. And here's the thing you have to think about: no matter what you think of Trump or Biden or Obama, or any of the presidents, none of them want a bad legacy. Think about that for a moment. Not a single one of them wants a bad legacy. Most of the reason they do it is to have a legacy and to be remembered as the president of the United States. That's why they do it, right? The Federal Reserve chair. Why does Powell do it? He doesn't make a lot of money. I think they make like $500,000 a year. It makes chump change compared to like anybody on Wall Street. Now, when he retires, they'll give him a lot of cushy gigs and he'll be making millions of dollars a year. But you don't become the Fed chair because you want to get rich. You become Fed chair because you want to be remembered. You want a legacy. And nobody wants a bad legacy. Okay. You could, we make fun of, we talk about Volcker having the best legacy. You could either be him or Burns. Well, Burns didn't get in there to have a bad legacy. It just so turned out that way. So nobody goes in trying to destroy the world. They go in, one, because of power, because everyone loves power. Power is an aphrodisiac. And the other reason is because they want to be remembered. So Trump is doing this because he wants to be remembered. And frankly, if I'm reading between the lines, he really does want to make this country great again, right? It's not just about him. I know he's got an ego, but it's not just about him. So, what he's doing and what we've talked about in the show, the Mar-a-Lago Accords, which we talked about in February, that's starting to eke out a little bit. Now it's starting to hit the public ear a little bit. I think we'll probably start to see that roll out in the summer, be my guess. But when that comes out, I'm really excited because I think that I don't know all the details. I know the broad strokes from what I've been hearing from others, which is what I share in the show. But all the details, there could be more to come. And I'm excited for what it could be. Now, I don't know if it ends up being great, but on the surface, it seems pretty cool. And it could change the whole game. Now, I was talking this morning with a client about this, and we're talking about gold. And gold, as we talked about last week, is one of the best performing assets this year. It has gone like gangbusters. And if you compare that to the stock market, and let me just share this is the S&P 500 this year. Lots of red. There's some green, consumer defense, some industrials, telecom, utilities, and insurance. But there's a lot of red. Here's Disney. We're talking about that. They're not so good. See some of the big tech. They're not so good. There's some good and bad. There's a mix of, and this is the year to date, by the way, as of April 18th. So, lots happened. I mean, that doesn't look good. That doesn't look good. That doesn't, these don't look good. But, the year isn't over. And what I think people should keep in mind is that there are many ways to invest. If this Mar-a-Lago Accord comes out, I was thinking about it yesterday. Gold could get a hit on the chin for sure. I mean, think about it. Let's say all our debt, and we've got, 30 some odd trillion, if you include, the responsibilities we have to like Medicare and Social Security and pensions and all that. I think it's something like 30 some odd trillion. So let's say you take all that and you extend it out for 100 years at 0%. It's kind of like you don't have it. It's like it doesn't exist because you're not making payments. So if they did that, we completely change the makeup of the income and expense of our government. We cut a lot of expenses, and now we've got a trim government. Our dollar goes through the roof because now we're easily the most secure and stable currency. The bonds are definitely not going to get defaulted on. You compare that with the rest of the world, we are going to be so far ahead of everybody. It's not even funny. And that won't be good for gold, in my opinion. It won't be good for hard assets because now all of a sudden the IOU something of the treasury and the dollar now has a lot more weight behind it. And now actually you could probably peg it to gold. You could peg it to crypto. You can peg it to hard assets. There's a whole bunch of stuff that can happen. And I don't want to predict because frankly, it's too early. And I'm just looking at scenarios right now. Like what are the scenarios that could happen and how is that going to impact things? I don't know. Like it's going to take some time, but I can tell you this much. I'm excited for it, but I also am very ready to make rapid changes to portfolios because no matter what you believe now, if this happens, you have to reassess everything you think you know, because it could change that much. It could be that the dollar is now like 100% higher because it's so strong compared to everybody else. I don't know. I'm guessing. Maybe the bonds, um, you know, bonds are yielding nothing because everything's so strong, right? I don't know. Like gold isn't, we don't have inflation. I don't know what's going to happen. My point is you have to think these things through. You can't assume because of A, B is true. Like we talk about in the show, correlation is stocks go up, bonds go down, bonds go up, stocks go down. That is a correlation that's held up more or less for many, many decades, but it's not always true. Didn't happen in 2020, didn't happen always in the 70s. Like there are times where it's not true. But if you think it's always true, you could get yourself in trouble. So you have to be aware that sometimes the rules change. And if you're not awake to that, you could lose a lot of money. So you should start thinking about each of your positions. Say, what about these positions, if it changed, would cause me to sell or buy more? You should do that. And you should do that every year, at least every quarter. It would be my recommendation. Go through your portfolio and say, would I still own this position today? If your answer is, if you ask yourself, would I buy this today? If the answer is no, you need to think about selling. Because I'm not saying you need to, but you should think about it, right? If your answer is no, God, I would never buy this position, maybe you should sell it, right? If your answer is, I love this company, I'm never selling it, okay, but you should think about it, right? You should at least have that conversation with yourself. Is this worth continuing? Because, I mean, look at a company like, I won't name it, but one of the biggest AI chip companies. And they were way over their skis with valuation, so much so that they couldn't keep up with, there's no possible way they'd be able to keep up with the demand. It just wouldn't be possible. So the numbers didn't make sense. Same thing happened in the late 90s with a lot of the tech companies like Cisco, pretty much every tech company. I want to pick on Cisco. Every tech company went through this where they just absolutely could not keep up with the numbers because they were unrealistic. When that happens, you should go sit in the sidelines because sometimes there's no feasible way. It's like saying, I don't know if anyone's ever been to like a multi-level marketing meeting. I know in my younger years I went to one, and you start doing the math and they're like, oh, well, you get here and you can get 5 people under you and they get 5 people and they get 5 people. And you start doing the math in your head. You're like, all right, so by level 5, I've got every single person on the planet under me. Like, that's not reasonable, right? So why are we looking at it as a scenario? And so when you think about, your investments, you should always look at what could go wrong, where could I lose money, what could happen that could cause me to change my thesis, where's my exit, basically. You should always look at what's my exit, and if I added more, what would I have to do that? Now, I'll give you an example, like crypto, looking at the two, Bitcoin and Ethereum. Bitcoin has held up reasonably well, given what's going on the last few weeks. Ethereum has not. Ethereum is down, was it 50% year to date? And then if you go back to, see if I can bring it up here. I'm just talking head. So this is Ethereum, right? And here's the end of the year. So it went from 3,300 down to 1,600. But if you take the high up at 4,000, it's down even more. So I would say Ethereum's had a pretty good route happen. Now, if you go back to, if you look back in the weekly chart, the lowest range it got actually could go to like 1,000 to 1,200. So it could have further to go. But, we're getting into the range where you just say, you know what? If you believe in it, it might be worth a flyer. Now, I'm not telling you to buy Ethereum. Definitely not. I'm not giving you investment advice. But this is a chart as an example I would look at and say, okay, if I think that that there is a bottom to this, there's an intrinsic value, then you're probably close to it, right? If you look in here, like this is a range right here from like 2,000 to 1,000 where you could see a lot of action where it didn't go any lower and people were buying and selling. Okay, I would say maybe we're going to start to see some of this, start to see some bouncing around. Now, I was listening, I interviewed a guest this week, and he's a crypto expert, And he was talking to me about Ethereum. We had a short conversation, and he was talking about intrinsic value. Now, I don't see intrinsic value having any place in like gold or in crypto, but he was talking about VanEck, which is a fund company, where they did a discounted cash flow model based on Ethereum, which I was intrigued at, and I'm still looking at it. And I saw their valuation. I'm not going to say it because you guys can go read it yourself. But point being is, okay, so there's an intrinsic value to this. Is there a cigar butt stock value to crypto? Like Warren Buffett talked about, it was actually from Benjamin Graham. He talked about cigar butts, like a stock that has $1 per share in cash and is trading for 50 cents. There's more cash than if you liquidate the company, you get $1 back, you make 100%. So that was Benjamin Graham's theory of like cigar butts. Now, in practice, that doesn't actually work because usually if that's the case, there's a reason. And the stock's probably going to zero eventually. They're just burning cash. But if you're looking at something like this and say, okay, where is the price that I would buy it if you don't own it? And if you do own it, where would be the price I'd want to buy more? Just a thought, something to think about. It's one of those opportunities we've talked about over time where you say, all right, this stock is or this crypto is bottomed out. Maybe it's not bottomed out, but we're getting there. So ask yourself, what would be a number that would make you comfortable where you'd say, okay, I want to add this to my portfolio. And maybe you put it on the watch list because it looks like it's still dropping. So maybe you put it on the watch list and say, all right, what point do I start adding? Don't know. Something to think about. Anyway, Doug, thoughts here? Got another 10 minutes before we wrap it up for the holiday weekend.
Yeah, I'm gonna run through a couple things really quickly here. Do me a favor, pull up the image that looks like gummy worms.
The gummy worm picture. Love that one. Let me bring that up
Yes.
here. Here we go. Let me share the screen. There we go.
All right. So since we're talking about the tariffs and it's on everybody's mind right now, imagine a colorful and winding path that twists and turns with each new tariff announcement. Each bend represents a significant event in the trade war. You got colors and symbols on this that are highlighting who made the move and how others responded. This is basically a visual journey through the escalating tensions between the U.S. and its trading partners. Here's the key thing to take away. It looks like a gummy worm because it's depicting a timeline of tariff actions with twists and turns all over the place. So I don't want to spend a lot of time really looking at this, too deeply. Just to understand that we went from a 10% increase in February, that doubled in 20% in March against China, and then an additional 34% tariff going up to 54% on Chinese goods, and then retaliated again after China, 145%. It has strained U.S. and China relations. It's impacted global markets. Stock markets have obviously been volatile because of it. If you want to understand what's going on in the markets, here's your gummy worms. I mean, the coloration, it looks and tastes good, but buy the package, it's all over the place. This is exactly why you are looking at volatility in the markets. They do not like this whipsawing effect of decisions and news that's being put out there. Tech companies like, NVIDIA and AMD, they have come out and reported substantial financial hits due to export restrictions and tariffs. You mentioned Cisco. Cisco used to be a gauge of the markets, right? A gauge of the economy. If we go down the road of AI being the new tech, it's possible that some of these chip companies become that new gauge of the economy, and that we're starting to see, we might see that. I'm not saying that it is, but I also want to, represent how American consumers are feeling the pinch as these tariffs, which may drive up prices on everyday goods. We've seen some prices go back up. Who knows whether or not that's directly related to tariffs or not. Sometimes these prices jump because of the expectation. We see that all the time, like a refinery blows up in the Middle East and, geez, gas prices are up the next day. It's like, well, we didn't get that gas yet, right? So some of the stuff might be reactionary price changes, and it may be to other variables we haven't felt yet. Retailers like Temu and Shine, if you were trying to go and get, cheaper goods through those sources, well, guess what? Those were ways that were sources of goods bypassing the middleman directly from China. Well, now if we've got these tariffs, they've already come through and announced impending price hikes. urging shoppers to buy now before it's too late, which brings me to another chart that I want to, move to. Kirk, we got a number of things about how the American consumer is actually reacting to the news that is out there right now. And what I think is some really, we've got some charts that, basically, show how the American consumer is reacting to making different purchases now. And we've got some really good demographics information on this. So this is 39% of Americans much less likely to make a major purchase this year. There's actually a chart that goes back a little bit further, kind of breaks it down. But 51% of people with emergency funds, have 0 to 6 months, so over less than half. If we go, back and look at, the ability to cover a crisis. I'm just going to summarize this a little bit because it's hard to kind of run through all of them, but it's interesting. Redfin did this survey, and it highlights what I thought was a takeaway is it's highlighting a significant partisan and demographic disparity about how Americans are responding to these tariff policies, especially with regards to reacting. So like Timo said, you better buy this now. Well, political affiliation is definitely playing a role in consumer reactions. The Democrats, 36% are canceling plans for major purchases and 43% are delaying them. Now, Republicans, only 15% are canceling and 20% are delaying. So it's showing that, if you are a believer in the current presidency, you believe that these things are going to have positive outlook and you're not too concerned. And if you are not a believer in the current presidency, it's going to suggest that, you're likely more apprehensive about economic implications of the tariffs. That's going to be differing levels of trust in the current administration's economic policies. If we're looking at age, younger generations, particularly Gen Z and millennials, are feeling more disproportionately affected. Homeowner rates, only 33% of 27-year-olds own homes today, compared to 40% of Gen Xers and 51% of baby boomers. That's leading to financial barriers like high home prices, elevated mortgage rates, substantial student debt are making home ownership more challenging. So if we add the introduction of tariffs, that's only exacerbating the concerns and fears of challenges by increasing costs for construction materials, vehicles, it further strains the financial capabilities that younger potential buyers might face. And if we look, into a broader sense of economic uncertainty, over half of consumers perceive that there's a higher than 50% risk of recession. That's going to lead to cautious spending behaviors. That is, of course, going to affect GDP and the outlook on a number of different things. And only 1/3 of respondents had more than 1/3 of respondents lacked an emergency fund to cover mortgage or rent payments in the event of a personal financial crisis. All that's going to lead to a further reluctance to engage in significant financial commitments and economic volatility. So where does that lead? So if we continue to have this uncertainty, there's actually we're showing data that in 2024, Americans purchased around 19.5 billion restaurant lunches. That's a 3% drop of 2023. And that's fewer than the pandemic's peak of 2020, despite people returning to offices. Inflation, a staggering 78% of workers say inflation has changed the way that they're doing lunch habits. More are planning their meals more carefully. They're opting to bring food from home versus rising, to avoid rising costs. 38% of Americans report cooking lunch at home more often, reflecting a broader pullback of dining out amid tighter budgets. So clearly there's more evidence that Americans are reacting to what's going on out there, whether it's actual higher prices or concerns about, feeling these economic pressures. And at the end of the day, what is that leading to? Well, I'm going to leave on this, that we are actually seeing that, that is going to potentially lead to a concern that there is going to be a greater impact on everything broadly. But let's talk home prices for a second. From March 31st, 2025 to March 31st, 2026, There is a chart. The charts are showing that there is going to be significant expected home price changes. Now, I'm not sure, Kirk, that that's actually playing in, taking into consideration the fact that we've got this new news out about mortgage fraud, out there, that potentially more people have bought second homes and third homes that have they applied for as primary mortgages, but they're not living in them. That is mortgage fraud. They're going to start cracking down on that, and if they find these people have done that, that could lead to not only foreclosure issues but legal issues. That could lead to people trying to sell these before these investigations start. We also know that there's been data out there that people have been getting significantly behind on paying their mortgages, getting more in default, and that has been suppressed. So this may not be taken into consideration, a possibility of a spike in supply that may have naturally come to market that has been diminished. But even just looking ahead without all of that, we're looking at a nationwide trend, of the 30 largest U.S. markets, home price changes over 3 periods, March, April, and June. We're looking at a March decline of negative 1.7 nationally, expected April decline of negative 0.3%, and a June decline of negative 0.6%. So March definitely worsened, but a gradual but widespread national declines. Some of the sharpest projected declines: San Francisco at negative 5.2%. We've got the Minneapolis region at negative 4.2%, I believe. We've got Denver at negative 3.6%. So some markets are holding up better than others. Generally did not have the same level of exponential increase. So Detroit, which has been suppressed in real estate for a long time, only looking at a negative 0.5%. Philly, St. Louis, negative 1%. Chicago, which did not have some of the appreciative prices of other areas, only negative 1.9%. Orlando, surprisingly, only negative 1.6%. But let's look forward, and I'll leave it at that. I don't think there's going to be a crash. I do think that the majority of declines look like a housing correction, maybe a gradual reversion, but not a 2008 style collapse. It is definitely seeming to be more likely rate-driven affordability correction. Inventory and rate, still rules. They're still assuming mortgage rates stay elevated. No major policy stimulus. A drop in rates could dampen or reverse these declines. And of course, there could be, impact of, relocation. So I don't think that these numbers take into consideration the potential issues that could come from a supply spike that might come from things that we don't know about how heavily investors were involved with being, or homeowners were involved with having to delay the realities of being behind on payments. I don't think it necessarily takes into consideration how much might be out there in terms of people that, have fraudulent loans. But I do think it is, an opportunity could come for opportunistic buyers. I think it's definitely going to be market sensitive, and it's not going to be an impact if you are looking at being a long-term holder. But understand that, between housing and everything else, it is starting to absolutely, you're starting to see that people are concerned and they're slowing down. And if they're slowing down in eating, they're slowing down in buying, they're slowing down in housing, you're going to feel that, and the markets are reflecting that concern whenever we hear more about tariffs.
Awesome. Well, let's wrap it up in the interest of time. I want to start my day off, and Doug probably does too. So, Doug, where can people find more about you?
Well, at my company is Mergent College Planning. We don't help families chase discounts. We help protect capital, reduce losses, and access advanced strategies most people never hear about. Think of it like building a private reserve for college. Every dollar works smarter. Every move supports long-term health. Even if you can write the check for college, that doesn't mean you should. It isn't about cheaper schools. It's about playing the game like elite families, strategically, deliberately, with leverage. The ultra wealthy, they don't just spend, they position. They use hidden strategies to gain control, create options, and lower taxes. That's the playbook we use to help families tap into. So if you're serious about protecting what you've built while funding top-tier education, something that is already expensive and getting more expensive, Check out more information on us, mergentcollegeadvisors.com, MERGENT, mergentcollegeadvisors.com. Listen, smart money doesn't guess, it plans. And these aren't hacks. They're the same strategies the elite have used quietly for decades. You can use this for you so you don't lose a dollar you shouldn't have to on something that is trying to help you lose all your money rapidly for the emotional price of a good education.
Great. Well, Doug, I really appreciate you coming on the show, sharing your Good Friday with us. That's the show for this week. Thanks again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and podcast app if you're choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment to the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling you products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send him an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.